All right, let's record a return of merchandise by our customer. So we're going to be recording a sales return. In order to do that, let's first start with a sales transaction. So let's assume we sold $10,000 of merchandise on account, debit accounts receivable, credit sales, $10,000 each, and to keep it simple, we're just going to assume at first no credit terms. Remember that we would also have to update the inventory account where we would debit cost of goods sold and credit inventory, and let's just say the cost of the merchandise was $4,000. What if the customer decides to return $2,500 of the merchandise and that merchandise had a cost of $1,000? How would we record that? We would have to debit sales returns and allowances for $2,500 and credit accounts receivable for $2,500. Sales returns and allowances is a contra revenue account. So when a customer returns merchandise, we don't debit the sales account. We debit this contra revenue account so that management can keep track of just how much our customers are returning merchandise. And we have to reduce accounts receivable because the customer doesn't owe us the full amount that they purchased up front anymore. Then we also have to remember to always update the inventory, debit the inventory account, credit cost of goods sold for the $1,000. So notice it's a complete flip-flop or reversal of the usual entry. When we sell, it's debit cost of goods sold, credit inventory. When the customer returns merchandise, inventory is coming back. So we have an increase to inventory, debit inventory for $1,000, and we're reducing cost of goods sold, reducing the expense by $1,000. Now, let's look at the account balances just so that we can see how the return of merchandise is affecting our different accounts. Accounts receivable started with an increase of $10,000. Then the customer returned $2,500, and so they owe us $7,500. The sales account shows the full $10,000 with no reduction, but the sales returns and allowance account shows a debit balance of $2,500, and so the true net or reduced value of sales is the $7,500. But instead of mushing it all together in one account, we record no debits in the sales account. Instead, any reduction, sales returns and allowances, and sales discounts go in separate contra revenue accounts. Now let's record the collection from the customer. Debit cash for $7,500, credit accounts receivable for $7,500 because we assumed there were no credit terms. If there had been a discount allowed, then it would be applied against the remaining balance, the $7,500, and not the full $10,000 original amount of the purchase. So sales discounts are only allowed on that net amount of the sale. Hope this helps.